Silver is trading around $68 an ounce, and the market is treating it like a pause, a consolidation, a breather after volatility. But that interpretation misses what's actually happening underneath. This isn't silver stalling. This is silver absorbing shock. And the shock is coming from a place most analysts don't have visibility into: China's hidden stockpiles. For years, China has reported modest silver holdings, framing itself as a producer, refiner, and consumer, but not a dominant holder. That narrative is now collapsing. Recent trade data, inventory movements, and import-export anomalies are pointing to something far more serious. China has been drawing down silver reserves quietly, faster than expected, and with far less transparency than markets assumed. And when a country that large begins depleting stockpiles of a critical material, it changes the global balance immediately. This is why $68 matters. Not because it's a technical level, but because it reflects a market that is starting to price in information it doesn't fully understand yet. Silver hasn't moved on headlines, it's moved on absence, on metal that should be available but isn't, on shipments that should be flowing but aren't, on inventories that were assumed to exist but may already be gone. China doesn't hoard silver for speculation. It hoards for strategy, for energy security, for manufacturing continuity, for defense. And once those reserves begin to thin, replacement becomes urgent. China is not a price-sensitive buyer when supply is strategic. It is a volume buyer, and volume buyers don't wait for pullbacks when they sense scarcity. That's how a $68 market quietly sets the stage for much higher prices, not through panic, but through necessity. What makes China's stockpile situation so important is how deeply silver is embedded into its economic model. China is not just the world's largest manufacturer, it is the world's largest integrator of materials into finished systems. Solar panels, power transmission, electric vehicles, electronics, defense hardware, and data infrastructure all rely on silver at scale. When stockpiles decline, production risk rises immediately. The warning signs have been there, but they've been easy to miss. Silver imports have remained elevated even as domestic output stabilized. Refiners have been operating at higher utilization rates. Export flows have tightened. At the same time, reported inventories at major exchanges have not reflected the level of metal required to support China's industrial demand. That gap doesn't resolve itself quietly. It resolves through aggressive sourcing. This is where the hidden stockpile narrative starts to unravel. For years, markets assumed China held deep reserves that could buffer supply shocks. But the behavior we're seeing now suggests those buffers are thinner than expected. When a country shifts from steady consumption to accelerated accumulation, it usually means internal reserves are no longer sufficient. Silver at $68 is the market's early response to that realization. Not a spike, not a blow-off, a repricing of risk. As China steps up purchases, it competes directly with industrial buyers elsewhere. That competition doesn't show up immediately in futures prices. It shows up in delivery delays, rising premiums, and tighter allocation. And once that process begins, forecasts that once sounded extreme stop looking so unrealistic. The reason a $120 forecast is suddenly back on the table has nothing to do with hype. It has to do with math. The silver market is small, thin, and highly sensitive to shifts in large buyer behavior. When a participant the size of China moves from balance to deficit, the impact is nonlinear. Prices don't rise proportionally. They jump as the market scrambles to reallocate limited supply. This is especially dangerous because most of the silver market still operates on assumptions formed in a very different era. Futures models assume ample above-ground inventory. ETFs assume continuous sourcing. Industrial contracts assume stable delivery schedules. Those assumptions hold only as long as stockpiles exist to absorb shocks. Once they're drawn down, the system has no slack. That's when pricing stops being about marginal demand and starts being about priority. Who gets metal first? Who pays premiums? Who waits? And who is forced to slow production? In that environment, price becomes a sorting mechanism, not a valuation tool. Higher prices don't signal abundance, they signal scarcity. China understands this dynamic better than most. It has lived through resource shortages before. It knows that once competition for physical supply becomes visible, the cost of waiting far exceeds the cost of paying up. That's why a stockpile drawdown doesn't lead to reduced consumption. It leads to accelerated procurement. As that demand collides with already tight global supply, the repricing can happen faster than most forecasts account for. A move from 68 to 120 doesn't require panic. It requires sustained buying pressure in a market with limited elasticity. And that is exactly the setup forming now. What makes this phase especially unstable is how little new supply can respond to higher prices. Unlike commodities where production can ramp quickly, silver is constrained by geology and by economics. Most silver is produced as a byproduct of mining other metals. That means even if silver prices surge, miners don't suddenly produce more silver unless copper, lead, and zinc production also increases. And those sectors are facing their own slowdowns, permitting delays and cost pressures. At the same time, refining capacity has become a choke point. Raw silver ore doesn't help manufacturers. It must be processed into high purity material, and much of that refining has been concentrated geographically. When large buyers compete for refined silver, bottlenecks appear quickly, shipments back up, lead times extend, and availability becomes uncertain long before price reflects the shortage. This is where China's role becomes critical again. China is not only a consumer, it is a central node in the global refining network. If its internal demand rises while stockpiles fall, less refined silver flows outward. Other countries don't just compete with China on price, they compete on access, and access is far harder to replace than cost. The dynamic feeds directly into volatility. As refined supply tightens, industrial users outside China face longer waits and higher premiums. Some hedge aggressively, others pull forward orders. That behavior drains visible inventories faster, reinforcing the perception of scarcity. Once that perception takes hold, the market doesn't wait for confirmation. It prices the future risk immediately. This is how quiet shortages become violent repricings. As this pressure builds, the first cracks don't appear in price charts. They appear in behavior. Buyers change how they operate. Contracts that once rolled smoothly start to tighten. Clauses that were ignored become important. Cash settlement language gets reviewed. Delivery windows quietly widen. These are subtle shifts, but they signal a market that is no longer comfortable with its own structure. We've already seen early signs of this in silver. Physical premiums have risen ahead of price. Large orders are being split. Some buyers are being told to accept partial delivery or extended timelines. None of this is dramatic on its own. Together, it paints a picture of a system rationing supply without announcing it publicly. This is why the stockpile issue matters so much. If China's internal reserves are thinning, it removes the final buffer the global market assumed existed. Without that buffer, every new demand shock hits the open market directly. There is no hidden inventory to smooth volatility. Price becomes the only release valve. At that point, forecasts like $120 stop sounding extreme. They become mechanical outcomes of constrained supply meeting sustained demand. Not overnight, not in a straight line, but through a series of sharp moves and uneasy pauses as the market struggles to adapt. What most participants underestimate is speed. Once confidence and availability fades, adjustments happen faster than models predict. The silver market doesn't have the depth to absorb prolonged competition between strategic buyers. It rebalances through repricing, and it does so abruptly. What this leaves us with is a market that is no longer governed by comfort or excess. Silver is entering a phase where availability defines everything. China's hidden stockpile drawdown isn't just another data point, it's a structural shift. When one of the largest industrial powers in the world moves from buffer to buyer, the entire pricing mechanism changes. At $68, silver isn't expensive, it's tense. It's a market holding its breath while supply realities catch up with demand commitments already made. And once that tension releases, it rarely does so gently. Price doesn't climb in neat increments when inventory buffers are gone. It gaps, it overshoots. It forces recalibration across industries that depend on it. This is why the $120 forecast is no longer dismissed outright. Not because it's guaranteed, but because the pathway exists. Tight supply, inelastic demand, strategic buyers unwilling to wait, and a market structure built on assumptions that are quietly breaking down. When those ingredients align, repricing becomes a process, not an event. What happens next will depend on how quickly participants recognize the shift. Some will wait for confirmation and pay higher prices later. Others will act early to secure continuity. But one thing is already clear. Silver is no longer trading as a passive commodity. It's trading as a constraint the global economy must work around. This is the stage where outcomes widen, where volatility persists, and where those who assumed hidden reserves would always appear are forced to confront a different reality. The story isn't that silver is at $68. The story is that the buffers are gone, and the market is beginning to price that in.